Picture a scene that is probably incredibly familiar if you've ever lived in or even just visited a bustling Indian neighborhood.
Oh, absolutely.
You know, you walk down this chaotic, noisy street, you're dodging motorcycles, maybe some street vendors, and you're just looking for some medicine.
Right.
And you spot the local chemist. It's this tiny open-air storefront, maybe just a counter, really jammed right between a tea stall and, like, hardware shop.
You just wedged in there.
Exactly. And behind that counter is a guy who has probably been there for 20, maybe 30 years.
Yeah.
And the shelves behind him are just this completely chaotic, towering stack of cardboard boxes.
It's organized chaos for sure.
Right. There is no barcode scanner. There's no sleek computer interface. You just hand him a crumpled handwritten prescription. He squints at it, turns around, and somehow intuitively navigates this seemingly random mountain of inventory.
He knows exactly where everything is.
He pulls out the exact foil blister pack you need. And, sometimes he even cuts the blister pack with a pair of scissors to give you exactly 3 pills because you don't want to buy the whole strip.
Which is a remarkable system, historically speaking. I mean, it is highly decentralized, incredibly relationship-driven, and it relies almost entirely on the localized knowledge of that single proprietor.
Yeah, you trust that chemist because your family has been going to him since you were a child.
Exactly. It's pure relationship trust.
But that dusty, chaotic, highly personalized image is, it's colliding head-on with a completely different reality right now.
It really is.
Because today, if you walk a few blocks down that very same street, you might see a storefront with bright uniform lighting. The shelves are mathematically organized.
Staff is in uniform.
Right. Every single pill bottle and blister pack is scanned, tracked, and verified through a centralized database. The air conditioning is humming, and you can buy your blood pressure medication, get your blood drawn for a lab test, and, pick up a bottle of premium baby shampoo all in one brightly lit 500-square-foot box.
It's a totally different world.
We are watching a tectonic shift in how one of the world's largest populations accesses healthcare. So welcome to the Deep Dive. We are thrilled you could join us today because we're unpacking a really fascinating structural transformation.
Yeah, we've got a lot to get through today.
You do. Our mission today is to tear down the engine of MedPlus Health Services Limited, or MedPlus as we'll call them, for this deep dive. They are India's second largest organized pharmacy retailer.
And they are moving fast.
Super fast. We are going to figure out exactly what makes this company tick, how it navigates this vast, historically fragmented Indian healthcare retail market, and what its highly aggressive growth strategy means for the future of how you dye your medicines.
It is an incredibly compelling story of formalization, but to really grasp what we're analyzing today, you kind of have to mentally step back and look at the sheer scale of the backdrop here.
Right, set the scene for us.
So we are talking about an Indian healthcare market that is rapidly digitizing and formalizing. For decades, the landscape has been dominated by millions of those independent, unorganized local chemists you just described.
The guy's cutting the blister pack.
Exactly. But that informal landscape is currently under siege. It is slowly giving way to these sleek, data-driven, omni-channel retail chains. I mean, we are watching the structural formalization of Indian healthcare retail happen in real time, block by block, pin code by pin code.
Okay, let's unpack this. Because to understand where MedPlus actually fits into this rapidly shifting, highly competitive landscape, we first need to understand the nuts and bolts of what they are selling.
And who they're selling it to.
Exactly. So at its core, MedPlus is a high-volume retail pharmacy network. Now, when you look at their revenue mix, you might expect a modern pharmacy to look more like an American drugstore, half convenience store, half pharmacy.
All right, like a Walgreens or something.
Yeah, exactly. But MedPlus is overwhelmingly tilted in one specific direction. A staggering 98 to 99% of their revenue comes directly from pharmacy retail.
Which is huge.
It is. We are talking about prescription drugs, over-the-counter medicines, vitamins, and medical devices.
And we really cannot gloss over that specific mix because it is the fundamental architecture of their entire business model. Prescription medicines are the undeniable anchor here.
How so?
Well, if you think about the psychology and the economics of purchasing, prescription medicine is a highly unique category. It creates recurring, non-discretionary footfall.
Oh, because you have to have it.
Exactly. Consider chronic conditions, hypertension, diabetes, thyroid disorders. If you are a patient managing one of these conditions, you aren't just buying medicine once and hoping for the best. You are forced to return to that store or open that app every single month, like clockwork.
Right. It's a completely durable demand driver. You don't delay buying your heart medication just because inflation ticked up or the economy is, in a downturn?
No, absolutely not. It is entirely decoupled from broader consumer discretionary spending. The macroeconomy can be booming or crashing, but blood pressure medication remains a non-negotiable household expense.
That makes total sense.
And that non-negotiable trip to the pharmacy is the golden ticket for MedPlus.
Mm.
Once they get you through the physical door or onto their digital platform for that necessary prescription refill, they have successfully brought you into their ecosystem.
And that's when they cross-sell you, right?
Exactly. That is the exact moment they introduce the other pieces of the pie. They do sell FMCG, fast-moving consumer goods, things like toiletries, baby care products, specialized soaps, sanitizers.
But the research explicitly makes clear these function strictly as basket add-ons.
Yes, they are not the main event.
So you walk in because your doctor told you to buy metformin, and you walk out with a metformin plus like a bottle of premium aloe vera lotion that was strategically placed right next to the checkout counter.
Precisely. You grab it while you're waiting.
But beyond the pharmacy and those FMCG add-ons, there is that remaining 1 to 2% of their revenue. It seems like a rounding error, honestly, but the sources break it down. That tiny sliver is made up of a mix of a smaller diagnostics business. Think pathology, blood draws, lab testing, and an opticals business, selling eyewear and contact lenses.
Now, on the surface, 1 or 2% seems almost irrelevant to the top line. I mean, why even bother with the operational headache of running pathology labs if 98% of the cash comes from selling pills?
Right, it sounds like a distraction.
What's fascinating here is that the diagnostics and opticals aren't financial distractions at all. They are strategic customer retention tools. They basically act as a funnel.
Okay, walk me through that funnel. Because running a pathology lab requires completely different staffing, right? You need phlebotomists, specialized transport, lab technicians. That's totally different from a pharmacist handing over a box of pills.
Oh, it requires entirely different infrastructure. But look at how they deploy it. On the diagnostic side, they have been operating on a subscription-style model, and they are increasingly shifting their focus toward B2B and corporate clients.
Interesting.
By integrating testing services, they are locking the customer much deeper into the MedPlus ecosystem. Imagine a corporate client uses MedPlus for their annual employee health checkups.
Okay.
Those employees are now registered in the MedPlus system. A phlebotomist draws their blood, the MedPlus lab processes it, and the results are delivered digitally. When those lab results come back showing, say, elevated cholesterol, and a doctor subsequently prescribes a statin.
Let me guess. Where is the most frictionless place for that employee to fill that new prescription?
Right there at MedPlus.
Wow, because they already have the app installed, their profile is set up, their history is there.
Exactly. It creates a closed-loop system of healthcare consumption. That 1% diagnostics tail is essentially wagging the 99% pharmacy dog by feeding it new, highly lucrative chronic patients.
That is incredibly smart. It lowers their customer acquisition cost for the main pharmacy business.
And they are doing all of this on a scale that is genuinely staggering. Just to give you the numbers, as of the second quarter of the 2026 fiscal year, MedPlus operates 4,930 stores.
Nearly 5,000 physical locations.
Yep. And they aren't just clustered in one specific region anymore. They are spread across 750 cities in 13 states and 1 union territory.
But here's where we have to address the elephant in the retail room. We live in an omni-channel reality. No one is just purely bricks and mortar anymore, especially post-pandemic. People want things delivered.
Oh, absolutely.
And MedPlus does have an online presence. According to the data, online sales make up about 6% of their revenue as of the first half of fiscal year 2025.
Right. And in the grand scheme of global e-commerce, 6% might sound relatively small, but their approach to online fulfillment is what warrants close attention.
How so?
Well, they aren't trying to replicate an Amazon model. They aren't building a gigantic million-square-foot fulfillment center in the middle of nowhere and relying on a fleet of trucks to ship boxes of vitamins hundreds of miles across the country.
That would kill their margins.
Exactly. Instead, they use their existing physical stores as localized delivery hubs. This keeps their logistics and last-mile delivery costs incredibly low.
Okay, I want to pause on that because the mechanics of last-mile delivery in Indian cities are notoriously brutal. We are talking about intense traffic, narrow lanes, complex addressing systems.
It's a logistical nightmare.
So it's not a traditional e-commerce warehouse model. It's more like a sprawling, decentralized web where every single neighborhood store is its own mini fulfillment center. So if I open the MedPlus app and order, say, a bottle of cough syrup and some bandages, it is probably not coming from a centralized warehouse outside the city limits. It is being picked and packed by an employee at the MedPlus just 3 blocks down my street and delivered by a local writer.
That is the crucial distinction. Their real estate strategy serves a dual purpose. The store operates as a traditional walk-in retail environment, capturing that neighborhood foot traffic, while simultaneously acting as a dark store or micro-fulfillment center for the digital orders originating in that specific PIN code.
But I have to push back on this product mix strategy for a second. Between managing the 98% pharmacy operations, running this complex web of mini fulfillment centers for the 6% online sales, trying to push FMCG impulse buys, and managing phlebotomists for the corporate diagnostic side.
It's a lot.
It is. Isn't there a huge risk of operational bloat? I mean, they are trying to be a specialized pharmacy, a pathology lab, a mini supermarket, and a quick commerce delivery company, all at the exact same time.
Yeah.
Doesn't that dilute their core competency?
It is a totally valid concern, and it represents a constant operational tightrope. The complexity of managing temperature-controlled biological samples for the lab business, alongside fast-moving consumer goods and strictly regulated pharmaceuticals, it's immense.
Right, it sounds exhausting just thinking about it.
However, the underlying logic is that healthcare is inherently fragmented for the consumer. You usually have to go to a lab for a test, then a doctor for a consultation, and then a totally different pharmacy for the medicine.
True.
MedPlus is betting that the operational headache of integrating these services is worth the long-term payoff of owning the complete patient journey. If they can solve that fragmentation under one brand umbrella, the customer lifetime value just skyrockets.
So to understand why MedPlus is willing to take on that operational complexity, and why they are expanding at this blistering rate of hundreds of stores a year, we really need to zoom out. We need to look at the size of the ocean they are swimming in.
Right, the macro picture.
Let's talk about the Indian pharmacy landscape, the total addressable market, and the structural tailwinds pushing this entire formalization narrative forward.
Well, that ocean is remarkably vast, yet it remains largely uncharted by the big corporate chains. Let me put some specific numbers to this because the scale is somewhat counterintuitive.
Okay, lay it on me.
We established that MedPlus holds roughly 14 to 15% of the organized pharmacy retail market. And with that 14 to 15% share, they sit as the second largest player in the entire country.
Wait, let me make sure I'm grasping the math here. 14% market share makes them the second largest player overall. That implies the organized sector as a whole is just a really small, fragmented slice of the total market pie.
That is exactly what it implies. The open, unorganized market, those millions of local, independent neighborhood chemists we talked about at the very beginning, is absolutely immense. It constitutes the vast majority of the pharmaceutical retail volume in India. So the structural reality of this industry is that organized chains like MedPlus, or their main competitor Apollo, aren't just locked in a zero-sum game trying to steal market share from each other.
Right, they aren't just trading the same customers back and forth.
Exactly. They are fighting a much larger battle to convert offline, mom-and-pop-led demand. They are actively trying to pull consumers out of the informal, relationship-based economy and integrate them into the formal, branded, barcode-scanned economy.
It's a share shift story.
It is a share shift story playing out inside a very large category rather than a battle for incremental gains in a fully penetrated retail market.
And there are some serious, undeniable tailwinds making that shift happen. The research highlights several durable forces propelling this formalization. We already touched on chronic disease prevalence, which drives those recurring sticky prescriptions.
Right.
But there is also a broader trend of higher overall healthcare spending as middle-class incomes rise across India. There is rapid digital adoption, with patients increasingly comfortable with teleconsultations and e-prescriptions. And crucially, there's a push for overall prescription formalization driven by regulatory pressures.
And if we look closely at those regulatory pressures, they really act as an accelerant for chains like MedPlus. Consider the Uniform Code for Pharmaceutical Marketing Practices or similar compliance frameworks that are becoming increasingly stringent.
How does that help the big chains?
Well, the government and regulatory bodies are pushing hard for modernization, which demands traceable, audited, and strictly branded retail channels. When regulations tighten around billing standards, inventory sourcing, batch tracking, and quality controls,
It's expensive to comply.
exactly, it naturally and heavily favors the organized players. A massive chain has the capital to invest in enterprise software, the legal teams to ensure compliance, and the technological infrastructure to standardize every single transaction.
And the independent chemist operating out of a 100-square-foot stall simply cannot afford that overhead.
They just can't.
This is so profoundly relevant to you as a consumer navigating your own healthcare choices. Think about the psychological shift happening here. When you go to that local independent chemist, the trust factor is entirely relationship-based.
Right.
You trust them because they have been operating on that specific street corner for 2 decades. They know your family, they know your doctor, they might even, extend you informal credit until payday. It is a deeply human interaction.
It really is.
But when you walk into a chain like MedPlus, the trust paradigm completely flips. The trust becomes brand and compliance-based. You don't necessarily know the pharmacist behind the counter.
Nope.
You trust the corporate logo on the sign.
Exactly. You trust the clean uniform, the barcode scanner, the brightly lit aisles, and the implicit guarantee that the medicine is genuine, properly stewing at the correct temperature, and completely traceable back to the manufacturer.
It is a completely different psychological contract between the buyer and the seller.
And that transition from relationship trust to systemic trust is the core thesis of MedPlus's existence. But, it brings up a very important counterargument.
Which is, if the unorganized sector is so huge, and these structural tailwinds of digitization and regulation are so undeniably strong, why hasn't a winner-take-all monopoly emerged yet?
That's the big question.
Right. Why hasn't one giant, heavily funded corporation just swooped in, burned billions of dollars in venture capital, and swallowed the entire country's pharmacy retail market overnight? We've seen it happen in other sectors like ride-sharing or e-commerce. Why is pharmacy retail so resistant to a rapid monopoly takeover?
It is a brilliant question, and the answer lies in the fundamental nature of the product itself and really the psychology of sickness. Pharmacy retail is hyperlocalized. It relies on immediate, non-negotiable convenience.
Okay, unpack that.
If you want to buy a new smartphone, you might be perfectly willing to wait 2 days for an e-commerce delivery to save a little money, right?
Yep.
But when you have a splitting headache or your child spikes a fever at 9:00 p.m., you are not willing to travel across town to a mega store, and you certainly aren't willing to wait 48 hours for a package to arrive in the mail. You want the medicine right now, in the next 10 minutes, from the closest possible source.
Sickness doesn't respect delivery windows.
Exactly. Sickness doesn't wait. Displacing that neighborhood chemist requires overcoming that immediate need. It takes time, it takes significant patient capital, and most importantly, it takes extreme local density.
Density.
Right. To win, a corporate chain has to be just as immediately convenient as the guy who has been operating on the corner for decades. You can't just have one big store in a city. You need a store in every single neighborhood.
So to win the macro game, you have to dominate the microgeography. That naturally transitions us into analyzing exactly how MedPlus attempts to achieve that extreme local density. Let's look at their competitive moat and what they call their cluster strategy.
Yeah, this is where it gets really interesting.
Here is where it gets really interesting, exactly. Because to set the board, we need to know who the major players are. Apollo Pharmacy is the undisputed #1 player in the organized physical space, holding about 19% market share.
Right.
MedPlus, as we noted, is a strong #2 at 14%. Then you see a pretty significant drop-off to smaller regional players like Wellness Forever, which sits at roughly 4% share.
But framing it as just a battle between physical stores ignores half the war.
Right, the digital side.
That is just the offline battleground. You also have a fierce digital threat rapidly encroaching on the space. We are talking about online-first pharmacies and quick commerce giants like Tata 1 mg, Pharmeasy, NetMeds, and Apollo's own aggressive digital arm, Apollo 2-7.
Crowded.
Very. Not to mention the rapid rise of ultra-fast grocery delivery platforms experimenting with over-the-counter medicines. These platforms are pushing app-based ordering, heavily discounting to acquire users, and trying to disintermediate the physical stores entirely.
So MedPlus finds itself fighting a deeply entrenched two-front war. They are battling Apollo for the prime real estate on the straits, and they are battling Tata 1 mg for the prime real estate on your smartphone screen.
Which is incredibly hard to do.
How does a company actually fight, let alone win, a war on two entirely different fronts with different economic rules? The research points to one major strategic weapon in MedPlus's arsenal: distribution density.
This is where their operations get highly strategic. MedPlus executes what they refer to as a cluster-based rollout.
Okay, what does that mean in practice?
They actively avoid planting a single massive flagship store in the center of a new city and just hoping consumers will drive 5 miles to reach it. Instead, when they enter a new market, they seek to systematically blanket the residential catchments.
They flood the zone.
Exactly. They want a physical store in virtually every distinct neighborhood of that specific cluster. This deep density is what allows them to confidently offer same-day, or in many cases, 2-hour delivery for their online orders.
And the numbers show this isn't just theoretical. Their coverage is incredibly deep in the areas they target. We are talking about an active presence in 2,709 distinct PIN codes.
That is a staggering number of PIN codes.
It really is. They have built dominant, almost insurmountable market shares in specific southern and eastern metropolitan areas. Looking at the estimates from fiscal year 2021, they held roughly 30% market share in Chennai, 30% in Hyderabad, 29% in Bangalore, and roughly 22% in Kolkata.
Right.
This isn't just about having a large absolute number of stores. It is about having a dense network of stores clustered right next to each other in a highly orchestrated grid.
And the operational brilliance of that clustering strategy is striking when you look at the supply chain logistics. By concentrating their stores in tight geographic zones, they can aggressively centralize their procurement and highly optimize their regional distribution hubs.
How does that look behind the scenes?
Well, the research notes a fascinating pivot in their supply chain architecture. For a while, they operated on a fairly standard one massive warehouse per state model, but they realized that just wasn't efficient enough for the local density they were achieving.
Too much distance to cover.
Right. So recently, they added 10 new regional warehouses in fiscal year 2025. They used these new facilities to subdivide the states into much smaller hyperlocal zones, with each individual warehouse now responsible for serving a tight cluster of about 250 to 300 stores.
Let's visualize the impact of that. If a delivery truck only has to drive in a tight 10-mile radius to restock 20 stores, rather than driving hundreds of miles across a state to restock 5 widely dispersed stores, I mean, the fuel savings, the time savings, and the sheer velocity of inventory movement completely changes.
Exactly. This deep clustering fundamentally lowers their inventory holding costs and their last-mile delivery costs. Because their stores are geographically clustered together and, critically, located in close physical proximity to the end consumer, the route-to-customer economics become highly efficient.
That's a huge advantage.
It is a physical infrastructure that the online-first players, who largely lack a dense network of physical footprints, struggle immensely to replicate. An app with a great user interface might be fantastic for capturing an order, but the physical reality of navigating a box of pills through intense Indian urban traffic to reach a patient's house requires hardened, localized infrastructure.
Which actually brings up a rather humorous yet incredibly telling note from the source material. The research analysts explicitly state in their competitive breakdown that Easy Diner, which is a restaurant reservation and food discovery app, is not a pharmacy competitor.
That seems incredibly obvious.
It sounds absurdly obvious, but it serves as a fantastic reminder that the barriers to entry in retail pharmacy are totally distinct from general consumer technology apps.
Oh, absolutely.
You cannot simply pivot a successful restaurant reservation app or a ride-sharing app into a pharmaceutical delivery platform overnight. The regulatory frameworks, the stringent licensing requirements, the complex cold chain supply requirements for certain biologics, these barriers are incredibly steep. You need specialized knowledge to store and transport insulin. You don't need that for a pizza.
It highlights the difference between software disruption and physical world disruption. Moving bits of data is easy. Moving highly regulated temperature-sensitive chemicals is hard.
But I want to play devil's advocate here and challenge this idea that their physical density makes them immune to the digital threat.
Okay, let's hear it.
Let's look at the rapid evolution of quick commerce players, platforms like Zepto or Blinkit, that are promising and delivering groceries in 10 minutes. If a Title 1 milligram or a quick commerce platform eventually figures out the regulatory hurdles and masters the logistics of delivering my essential medicines in 10 minutes flat, doesn't MedPlus's physical store network suddenly morph from a competitive moat into a really expensive liability? All that commercial rent, all those utility bills, thousands of physical employees. It seems like a heavy anchor in a world shifting to instant digital gratification.
You are hitting on the exact vulnerability that keeps retail analysts awake at night. The market actively worries about this scenario, but if we analyze MedPlus's defense strategy, they argue that their dense physical footprint is their quick commerce engine.
Wait, how does that work?
The physical stores are already holding the highly regulated inventory at a localized neighborhood level. An app-only player, to achieve genuine 10-minute delivery, is forced to spend massive amounts of capital building a network of dark stores warehouses hidden in residential areas strictly for fulfillment.
Okay, I see where this is going.
MedPlus argues they don't need to build dark stores because they already possess thousands of well-lit, fully staffed, heavily stocked stores sitting in those exact neighborhoods. They are leveraging their existing retail stores as their own internal dark store network for online fulfillment.
It is the ultimate omni-channel defense. You let the customer decide, walk in and buy it, or tap an app and have a rider pick it up from the exact same shelf.
Precisely. However, we cannot ignore the inherent risk in this model. It remains their biggest structural vulnerability.
What's the risk?
Well, if consumer behavior radically shifts and customers completely migrate to ordering via pure-play digital apps, the physical foot traffic stepping into MedPlus's retail locations inevitably drops.
And if the walk-in traffic drops, they lose the impulse purchases.
Exactly. They lose the margin-rich FMCG sales, the soap, the premium shampoo, the vitamins you buy just because you saw them at the checkout counter. Their store-level unit economics would take a severe, potentially fatal hit.
Because they'd still be stuck with the rent.
Exactly. They would still be burdened with paying the fixed commercial rent, the electricity, and the staff salaries, but they would only be fulfilling online orders, which inherently carry additional delivery costs and often require aggressive discounting to stay competitive against the digital pure plays.
And if those impulse buys disappear, the math just breaks down, which is the perfect entry point to examine the actual math. We need to look closely at how these individual stores make money, how they justify their expensive real estate, and what the research identifies as their true secret weapon.
The unit economics.
Exactly. Let's break down the money engine and the unit economics of a single MedPlus location. So according to the data, a mature MedPlus store, which the company defines as any location older than 12 months, operates as a highly efficient financial machine.
Very efficient.
Historically, the average monthly revenue for one of these mature stores was hovering right around 10 lakh rupees.
10 lakh rupees a month is a solid top-line number, but the profitability metrics are what really stand out here. Those mature stores generate an EBITDA margin of around 10.9%.
Okay.
And even more impressively, they generate a store-level return on capital employed, or ROCE, of roughly 59.8%.
I want to stop you right there, because a near 60% return on capital employed in physical retail is an absurdly high number. Most traditional brick-and-mortar retailers would be ecstatic with half of that. How does a pharmacy achieve software-level returns on capital?
It's all about how they set up the stores.
The research points out that this works primarily because setting up a new store is remarkably capital light. The initial capital expenditure, the capex required to fit out, shelf, and open a brand new location, is just 7 to 8 lakh rupees.
It's surprisingly low.
Right. Add to that maybe a 2 to 3 lakh rupee rental advance required by the landlord. So for roughly 10 to 11 lakh rupees up front, you are opening the doors. We're talking about incredibly small, hyper-optimized retail spaces that average only about 527 square feet.
Just 527 square feet.
That is a tiny physical footprint, essentially the size of a large living room, pushing 10 lakh rupees in revenue every single month.
It is a masterclass in spatial efficiency. Every single square inch of that 527 square feet is meticulously planned. But the top-line revenue alone doesn't explain how they extract those margins.
Right. What's the secret?
The major gross margin lever, the absolute secret sauce driving the profitability of the MedPlus engine, is their private label business. Private label sales currently sit at 21.5% of their total revenue.
This is where we really need to peel back the layers of the product mix, because clearly not all pharmacy sales are created equal. Let's break this down. Branded pharmaceutical products, the name brand drugs manufactured by the big multinational pharma companies, the specific medicines your doctor writes on your prescription pad, these are relatively low-margin items for the retailer.
Yeah, the manufacturer captures most of the value there.
However, these branded drugs are absolutely essential to the store's survival because they drive the high, recurring volume of foot traffic. You walk into MedPlus specifically because you need that exact branded drug to manage your health.
That is the crucial first step. But once you step inside, MedPlus's strategic objective shifts. Their goal is to seamlessly introduce you to their private label pharmaceutical and wellness products.
Your own brands.
Exactly. These are products manufactured specifically for MedPlus, sold under brands that MedPlus wholly controls. Because they bypass the massive marketing and distribution markups of the big pharma companies, these private label products carry significantly higher gross margins for the store.
Okay, I see it.
MedPlus is essentially utilizing the low-margin, high-demand branded drugs as a traffic driver. They get you in the door with the drug you have to buy, and then their pharmacists and store layouts work to convert you to their higher-margin own brands, allowing MedPlus to capture the entire economic value chain of that sale.
It is incredibly clever, and it is a strategy we have seen work flawlessly in other retail sectors. Buy low from contract manufacturers, sell at a standard retail markup, and slowly swap the national brands on the shelf for your own brands where you control the whole supply chain.
Classic retail playbook.
It is the classic grocery store playbook. Think about how supermarkets push their own store brand cereal or paper towels, but applied to the highly lucrative world of medicine. But applying that playbook to healthcare introduces a completely different set of psychological frictions.
It really does.
What does this actually mean for the customer standing at the counter? Let's walk through a scenario. If I go in with a prescription for a very specific, widely trusted brand of blood pressure medication that my cardiologist explicitly wrote down, and the pharmacist behind the counter actively pushes a MedPlus brand substitute, telling me it has the exact same active ingredients, but it's cheaper. Isn't there a huge risk that I get annoyed?
Oh, absolutely.
I might feel like I am being aggressively upsold or pushed toward a lesser generic product, and the next time I need a refill, I just go down the street to Apollo to avoid the hassle.
You have identified the central tension of their entire business model right there.
Yeah.
It is an incredibly delicate, high-wire balancing act. Trust is the absolute currency in healthcare.
Yep.
If a patient feels they are being pushed into a medical decision purely for the store's profit margins rather than their own health, that trust evaporates instantly. And we don't just have to guess if this is a risk. The data from the sources shows us exactly what happens when MedPlus gets that delicate balance wrong.
Did they mess it up recently?
Yeah, in the first quarter of fiscal year 2026, MedPlus experienced a significant stumble. They actually reported flat to negative same-store sales growth.
Oh, wow. That is a glaring red flag for a company built on rapid compounding expansion. What went wrong?
The management commentary surrounding that quarter indicates that this stall happened precisely because they pushed their private labels far too aggressively at the store level.
They got greedy.
They incentivized their staff to push the high-margin products, and they simultaneously ran into supply chain issues, ensuring the availability of the demanded branded products. The consumers immediately pushed back.
Naturally.
Faced with aggressive substitution tactics and stockouts of their preferred brands, customers simply walked out and took their prescriptions elsewhere.
Wow. They flew a little too close to the sun. They prioritized margin extraction over customer experience, and the market punished them immediately.
It was a harsh lesson in retail psychology. Management had to rapidly intervene. They actively had to redesign their entire store-level incentive structures.
They had to dial it back.
Exactly. They had to recalibrate the targets to ensure a healthier balance between selling the necessary branded traffic drivers and the profitable private label products, strictly to prevent further customer attrition. You simply cannot forcefully shove the high-margin product down a consumer's throat if it alienates the very foot traffic your entire real estate strategy depends on.
So the MedPlus machine clearly works, but it is highly sensitive. It requires constant, meticulous tuning of incentives and inventory. But let's shift our focus to the fuel required to run this machine.
The financials.
Right. Opening 600 or 800 of these stores every single year, even if they are hyper-efficient and only cost 10 or 11 lakh rupees in total upfront capital to set up, it requires serious, sustained capital outlay. Let's look under the hood at the financial health and the management execution of MedPlus. How financially robust is this company, really?
Well, if you glance quickly at the headline numbers on their balance sheet, they operate with effectively zero traditional financial debt.
Zero. There are no huge bank loans or corporate bonds hanging over their heads.
None of the traditional stuff. But reading that zero debt headline requires a much more sophisticated look at how retail accounting works. While it is true they don't have traditional bank debt weighing them down, they have substantial lease liabilities.
Ah, the rent.
We are looking at figures in the billions here.
Yeah.
10.1 billion rupees in non-current lease liabilities and another 1.83 billion rupees in current lease liabilities.
And that makes perfect sense when you step back and think about it. They operate nearly 5,000 physical stores. They have to pay commercial rent on every single one of those locations. every single month without fail.
Exactly. For a sprawling retail operation like a pharmacy chain, rent acts as a massive, fixed, debt-like obligation. The real financial leverage in this specific business model isn't a loan secured from a bank. It is the aggregate weight of those thousands of multi-year lease commitments.
So how do they manage that cash flow?
Well, their working capital dynamics, the day-to-day flow of cash, are heavily tied to two vital metrics. First, inventory days. Exactly how many days a box of medicine sits idle on a shelf before a customer buys it.
Right, that's cash trapped on a shelf.
And second, supplier payables.
Yeah.
Exactly how many days MedPlus can negotiate to delay paying the pharmaceutical manufacturers after receiving the stock. They are in a constant race to turn that physical inventory into cash as quickly as possible to generate the liquidity needed to pay those fixed rental obligations.
And historically, they seem to be managing that race quite effectively. Looking at the numbers for the first half of fiscal year 2026, their operating cash flow was a robust 3.13 billion rupees.
Which is very healthy.
Yeah, that cash generation easily covered their required capital expenditures, the cost of opening new stores and maintaining old ones, which sat at 427.7 million rupees for the exact same period. They are generating plenty of internal cash from their daily operations to organically fund their aggressive growth.
And looking at the bottom line for the second quarter of FY26, they reported a profit after tax, or PAT, of 555 million rupees.
But looking beyond just the quarterly numbers, there is a clear strategic shift happening at the top leadership level. The management team, led by founder Gangadi Madhukar Reddy, is visibly altering the playbook.
We are definitely seeing a maturation in their corporate posture. Following a period of highly aggressive, almost breakneck expansion, remember, they added 618 net new stores in FY26 alone.
That's almost 2 stores a day.
It is. But they are now actively communicating a strategic pivot towards stabilizing their growth. They are publicly aiming for a more measured, sustainable growth rate of roughly 5.7 to 5.8% in the near term.
Okay, so they're slowing down a bit.
The narrative has shifted from land grab to prioritizing profitability, operational efficiency, and maximizing the productivity of their mature store base. Now, they still plan to open roughly 800 net new stores in FY27, which remains a formidable number, but the overall corporate posture is undeniably more disciplined. It is no longer an ideology of growth at all costs.
Which makes logical sense.
Yeah.
If they got burned a bit on the aggressive private label push and saw their same-store sales growth temporarily flatten out, they realized they need to take a breath and actively digest the growth they have already achieved. But speaking of the founder and the leadership, there is a glaring red flag in the financial sources that we absolutely cannot ignore.
The pledges?
Yes. The promoter pledges currently sit at an uncomfortably high 60.7%.
This is a critical point of vulnerability. For those analyzing the structural risks of the company, a high promoter pledge represents a significant control and financing risk. Let's break down the mechanics of what this actually means.
Please do.
When a founder or promoter pledges their shares, they are essentially using their ownership stake in the publicly traded company as direct collateral to secure personal loans or loans for their other related private business ventures.
Okay.
Now, to be fair, the company stated in a recent quarterly update that there were no new encumbrances or additional pledges created recently. However, the high absolute level, over 60% of the promoter's holding being used as collateral, acts as a persistent dark cloud over an otherwise relatively clean balance sheet.
Let's play out the worst-case scenario for a listener trying to understand the gravity of this. What is the actual tangible danger of this high pledge percentage for an everyday retail investor holding MedPlus stock?
The danger lies in the mechanics of a margin call. If the stock price of MedPlus were to drop sharply for any unforeseen reason, perhaps a disastrous earnings report, a sudden regulatory crackdown that crushes margins, or even just a broader macroeconomic panic that drags the entire stock market down.
Right, if the stock tanks.
The financial institutions that lent money against those pledged shares might suddenly demand additional collateral because the value of the underlying asset has shrunk. If the promoter is unable to provide that additional cash or collateral, the lenders possess the legal right to force sell those pledged shares directly onto the open market to recoup their loan.
And dumping millions of shares onto the open market indiscriminately.
Exactly. That triggered forced selling can cause the stock price to cascade downward rapidly, completely independent of how the actual underlying pharmacy business is performing on a day-to-day basis. It introduces extreme volatility, restricts the management team's financial flexibility, and generally depresses market sentiment.
It is essentially the sword of Damocles hanging over the stock, tethered to the founder's personal financial maneuvers rather than the company's operational prowess.
It's definitely something to watch.
But returning to the operational side, there's solid evidence in the source material that the management team is exercising newfound discipline. They aren't just blindly empire building to hit a store count target.
No, they're being smarter about it.
The sources show a pattern of active pruning within the network. They decisively closed 77 underperforming stores in the fourth quarter of FY26, and they closed another 28 in the second quarter of FY26. I actually view that as a highly positive signal.
It is.
It demonstrates that leadership is willing to admit defeat, swallow their pride, and cut their losses on bad locations or poor micro-markets that simply aren't hitting that crucial 10 lakh a month maturity target.
It is absolutely crucial for intelligent capital allocation. You cannot allow a tail of chronically underperforming stores to quietly bleed cash and drag down the exceptional returns generated by the healthy, mature clusters. Active pruning is the hallmark of a disciplined retail operator.
So we have a complex picture. The MedPlus machine is undeniably generating cash. The individual stores are highly profitable once they reach that 12-month maturity mark. And the management team is showing signs of stabilizing the ship and focusing on margins. But what could fundamentally throw a wrench into these gears?
The risks.
Exactly.
Oh.
That brings us to our final area of analysis, the core risks facing the business model and the market's ultimate verdict on their strategy. Based on the research stack, we have a clear bull case and a clear bear case. Let's start by dissecting the three major systemic risks threatening MedPlus right now.
Okay, let's break them down.
First, we have already debated the existential threat of quick commerce and online-only competition. Second, we have deeply entrenched regulatory risks. And third, we have the internal risk of store economics deteriorating, essentially. The danger that their aggressive rollout of new stores fails to reach the required maturity metrics.
Let's focus our analysis on that regulatory threat because it is arguably the most unpredictable and potentially devastating variable in their equation. MedPlus operates within a highly scrutinized, heavily regulated healthcare sector.
That's just the nature of pharmacy.
Right. They are constantly exposed to sudden shifts in Indian drug pricing rules, complex local pharmacy licensing requirements, and strict compliance mandates for dispensing prescriptions. Furthermore, because of their FMCG product lines, they also fall under the purview of FSSAI, the Food Safety and Standards Authority of India.
I want to dig into that FSSAI friction. Because if you are selling baby food, protein powders, and specialized nutritional supplements alongside heavy prescription drugs, you are suddenly dealing with food safety inspectors on top of drug controllers. It multiplies the compliance burden exponentially.
It does. Every single one of those 5,000 stores has to maintain separate documentation, separate storage protocols, and pass distinct inspections for both pharmaceutical compliance and food safety standards. It is an administrative nightmare.
Sound like it.
But the most acute regulatory vulnerability they face revolves around discounting norms.
The discounts.
MedPlus aggressively uses price discounts, often offering flat percentage discounts on large orders to acquire new customers, especially those highly lucrative patients requiring long-term chronic therapies.
So what happens if regulators step in?
Well, if regulatory bodies decide to intervene and enforce tighter, restrictive rules on how much medicine can be discounted, perhaps, to protect the smaller, independent chemists from being completely priced out of the market, it would instantly neutralize MedPlus's primary customer acquisition strategy.
That would be devastating.
Or, alternatively, if regulators demand much stricter, more time-consuming bureaucratic documentation for every single prescription dispensed, it would drastically slow down the speed of service at the counter and significantly raise their ongoing operating costs.
A stroke of a pen by a regulator could fundamentally alter their unit economics overnight. And the broader stock market is hyper-aware of these execution and regulatory risks.
Definitely.
When you look at the historical data on how the market has reacted to MedPlus's public performance, it certainly hasn't been a smooth upward trajectory. The stock has experienced violent, punishing drawdowns on relatively minor earnings misses.
The market is skeptical.
The market is clearly, and perhaps rightfully, pricing in the immense execution risk of opening 800 new physical stores a year. Investors are demanding proof quarter after quarter that the stellar economics of the mature stores can actually carry the dead weight of the immature stores and the sprawling corporate overhead.
And that tension you just described is the exact dividing line between the bull and the bear case for the stock.
Right, let's look at those.
The market's bull case argues that MedPlus will continue to execute their cluster strategy flawlessly. The bulls believe MedPlus will inevitably become the dominant, undisputed, organized chain across India, that their strategic push into private labels will continue to expand their gross margins significantly.
And the density moat holds up.
Exactly. That their incredible localized store density creates an unbeatable physical moat that permanently keeps the digital-only players at bay.
It is a compelling narrative of physical dominance. But the market's bear case is equally persuasive. The bears argue that despite the high ROCE at the individual store level, MedPlus as a corporate entity will remain a fundamentally low-return retailer.
They see a ceiling.
They argue that the fierce, multi-front competition from Apollo and Tata 1 milligram permanently caps MedPlus's pricing power, meaning they can never really raise prices to expand margins without instantly losing customers. Furthermore, the bears believe that MedPlus's relentless, aggressive expansion will continually depress their near-term corporate profits.
And frankly, there is hard data to support the bears' skepticism.
Let's hear it.
Looking historically, MedPlus's return on equity, or ROE, calculated over a 3-year period, sat at a very modest 8.48%.
So I have to pose the ultimate question to you. If the individual mature stores are yielding a staggering 60% return on capital employed, why is the overall corporate return on equity sitting mired in the single digits? The math feels contradictory.
It feels contradictory, but it is a classic retail phenomenon known as new store dilution.
Okay, explain that.
Imagine a bucket filling with water, but with a large hole in the bottom. When you have a solid foundation of mature, highly profitable stores, those stores are generating massive amounts of cash. But when management decides to take that cash and aggressively open hundreds of brand new stores every single year, those new stores act as a heavy financial anchor on the aggregate corporate returns.
Because they don't make money right away.
Exactly. Think about the life cycle of a new store. It incurs immediate upfront capital expenditure to build out. It incurs immediate fixed monthly rent and immediate staffing costs from day one. However, the revenues for that specific location take 12 to 18 long months to slowly ramp up as the local neighborhood discovers the store and shifts their buying habits.
So for that first year, year and a half, they're just bleeding cash.
Right. For the first year, those hundreds of immature stores are operating at a loss, or at best, breaking even. These heavy initial costs drag down the mathematically stellar returns generated by the older, mature cohorts.
So the whole thesis is a race.
The entire long-term investment thesis for MedPlus hinges entirely on reaching a critical inflection point. Can the expanding base of mature stores eventually generate enough sheer profit to out-earn the persistent financial drag of their relentless expansion?
They are essentially running on a high-speed financial treadmill, and they have to run fast enough that the highly profitable older stores can pull the heavy, unprofitable new stores forward into maturity without exhausting the company's cash reserves. It is a deeply delicate, high-stakes balancing act of capital allocation.
It really is.
So looking at this enormous, complex machine, what does this all mean for the person listening right now? Let's bring all these threads together. For you, the listener, whether you are simply dashing out to pick up a bottle of vitamins or you are meticulously managing a complex chronic condition with monthly refills, MedPlus is no longer just a convenient physical shop on the corner.
No, it's much bigger than that.
It is a front-row seat to the structural formalization of India's retail economy. When you walk through those doors, you are stepping into a complex ecosystem that is constantly balancing aggressive real estate strategy, the subtle behavioral psychology of private label substitution, and the intense logistical puzzle of hyperlocal last-mile delivery.
And I would add a piece of practical advice for the listener.
Oh, please do.
The next time you walk into any chain pharmacy, whether it happens to be a MedPlus, an Apollo, or a regional competitor, I encourage you to pause and really analyze the physical shelves. Look closely at exactly how much of the prime, highly visible eye-level real estate is fiercely dedicated to the store's own private label brands versus the established national brands you recognize from television commercials.
That is a phenomenal point.
You are literally watching their high-stakes margin strategy play out in physical space right in front of you.
The physical layout of a retail store is essentially a three-dimensional financial document, if you know how to read the shelves. It tells you exactly where they make their money.
Exactly.
As we wrap up this deep dive, I want to leave you with one final provocative thought to mull over. Circling back to the tension we discussed earlier between physical retail and digital convenience. We have spent an hour dissecting this incredible physical retail machine, but the consumer landscape is shifting faster than ever.
It is.
As aggressive quick commerce platforms increasingly train our brains to expect our groceries, our snacks, and our electronics delivered directly to our front doors in under 10 minutes, will our baseline expectations for healthcare inevitably follow suit?
It's a great question.
If 10-minute delivery for essential medicines becomes the absolute, non-negotiable baseline standard for the Indian consumer, does the neighborhood physical pharmacy with its air conditioning and its neatly organized shelves become the ultimate untouchable competitive weapon because of its localized inventory? Or, conversely, does it eventually become a nostalgic, expensive relic of the past, destined to be replaced entirely by hidden, hyper-efficient dark stores?
It is a fascinating high-stakes space to watch unfold.
It really is. Thank you so much for joining us on this deep dive into the mechanics of MedPlus. We'll catch you next time.